I hope you're all having a happy Labor Day and you're uh, doing whatever you enjoy doing on this Labor Day. And to that point, I want to briefly speak with you about the Bitcoin market specifically, and what is happening with the Bitcoin market. And if you've been looking at what's been going on with the assets like Bitcoin, Solana, Ethereum, BNB, Litecoin, Polkadot, all these different assets, Ethereum, I said Ethereum, right? ADA, you name it. The relatively top assets or liquid assets or good projects that have been around that are likely to be around for a while. Right? Including XMR. I know a lot of people are like, oh, privacy coins. Yeah, well, in many ways, I always say XMR is what people think Bitcoin is, right? But it doesn't matter. If you look at what's actually been happening in the crypto market in the last 48 hours or so, right, since the traditional markets closed, roughly. Yeah, well, more than 48 hours, but yeah, since Friday when they closed, you'll notice there's been a lot of up and down, mostly down, and currently it's down in large part. And this is like the Bitcoin birthing bull labor pains, right? This is the time before the market opens when people who are trying to jump the gun are going to find it hardest to make quick entries and get big returns because the asset keeps bouncing around between certain volatility levels. And people who don't even know what those are wondering to themselves, how can I make profit on an asset that just keeps going up and down, up and down? It looks like it's just going sideways, just going down. Well, first of all, you can make one on an asset, whatever direction it's going, up or down. And if it's going up and down too quickly for you, you can always trade an asset that's going up and down slower, because all assets do is go up or down or sideways. Right? When they're volatile, they rarely go sideways. Right? Why? Well, because if there's a supply and there's a demand, then there will always be a variation or a variance in the prices that people are willing to pay for that stuff. What does that mean? Well, that means that there will be a variance or a spread of data between the ask and buy, the ask and bid price, the buying and selling price. And that means that you're going to have a delta, a difference between the buying and selling price. And that delta, that difference, which is measurable because it's a number. Let's say I'm going to charge you 72 and you want to spend 59. So somewhere one of us is going to have to compromise, or maybe both of us have to compromise. Maybe we'll meet in the middle, maybe we'll meet at one end or the other, right? There will be a mean. Maybe, anyway. So there will be an average when you gather up all the orders for buys and sells. There will be an average of the buys and sells of those prices. Right? Those prices are set by the standard deviation of the returns. People see, the going price. Well, those prices are based on the returns. It's not the other way around. So the prices people set are based on the returns that are active. I know it sounds backwards to some people who are new to this idea. They're like, what are you talking about? The prices create the returns. No. The returns create the price. the standard deviation of returns create the actual price, because the volatility, right, is that standard deviation of returns. And when you correlate that volatility with the past price action, not the current, the past price action, then you get an indication of what the current and future price action will be. Again, I know it sounds very confusing, not at all logical to a lot of people. That is how trading works. That is how you trade volatility in the marketplace. And that is why you can literally always trade it in a 24-hour marketplace. Doesn't matter if the thing seems slow, or the thing seems normal speed, or the thing seems fast. Doesn't matter if the volatility seems like it's moving at a slug's pace or super fast. Doesn't matter. It's always moving, because volatility is always changing from candle to candle with respect to its relation to the correlation of the past price action. There will always be a difference from candle to candle on whatever time frame, even if the price doesn't change from candle to candle. The volatility and the correlation will, right? I know you can say, well, why? You could have volatility at 100 and correlation at 0, and that can happen for a few candles. Yes, it can. They're still changing. And by the way, just so we're clear, it is extremely rare, but it does happen. So yes, it can. And that is still change in the data set. Why? Why is there a change in the data set? Well, because if it happens on one candle, then it's happened on one candle. Once it happens on another candle consecutively, then it's no longer an event that's happened on one candle. It's an event that's happened on two candles. Well, how is that different? Well, it's different because it now changes the dynamics of the probabilities on that time frame and others, especially the ones that are above it. Meaning, if it happens on two 15-minute candles in a row, suddenly it's going to impact the 30-minute candle very differently than if it just happened on one 15-minute candle. Because suddenly that 15-minute candle is a 30-minute candle, right? Or is two 15-minute candles split over the back half and front half of two 30-minute candles. Either way, it's going to change the dynamics. Suddenly, if you have two 15-minute candles that did what appears to be the same thing on volatility and correlation, suddenly your 5-minute candles look very different. Your 10-minute candles look very different. Your 9-minute candles look very different. Your 3-minute candles look different, right? So it does make a difference. And that's, by the way, why it doesn't typically happen on anything like a 15-minute time frame, that you have two candles in a row that appear to do exactly the same thing on the volatility and correlation, by the way, because 15 minutes is quite a long time. I know it may not seem that way if you're trading low time frames, but not super low time frames. Like if you're trading the 15-minute and you're used to that, it may seem like, yeah, it's just a candle. Yeah, it is just a candle. 15 minutes. But if you're trading like the 1 minute, which many people do, 15 minutes is a long time. That's very often enough to get at least a couple trades in. And if you're like a bot, you can be trading sub 1 second, right? And I'm not suggesting that you are a bot or that you trade as a bot. But think about it, right? The firms that do use bots, the high frequency trading firms that use really big, powerful bots, the ones that actually run more than 80% of the market orders on the market, they're not running just sub 1 second. They're running millions of trades per second. So to them, a bought trade the last 15 minutes is the computer broken? When your trades last 0.2 seconds and you're running millions of them every second, you're running millions of orders per second. You're in, you're out, you're in, you're out, you're in, you're out constantly, but you're running millions of those orders per second. Then 15 minutes is like an eternity. Think about how many trades a bot would be doing. If it's running just 1 million trades per second, over 1 minute, that'd be 60 million trades. Times 15. We're talking like 900 million trades, right? In 15 minutes. And you want to tell me that there's no difference? Like, there's companies building their fortunes on this kind of stuff. So a 15-minute candle is not insignificant to whoever has the right position size, and the speed to take advantage of it, and the info to take advantage of it, because those are the three things that in theory you can control, that can give you, an enhanced probability of winning trades at whatever time frame you happen to want to trade at. If you don't have the right position or the right position size, and there is, by the way, again, I always have to remind people, position and position size are related, but they're not always identical. Yes, most of the time position is based off of position size, but it's not always, right? Like, there are times when the small orders do get to the front of the line and get filled. For example, now, at this time, before traditional markets are open, right? When it's mostly just a bunch of mice playing around while the fat cats are away. At this time, a whole lot of mice getting to the front of the line, running small orders. Once in a while, you have a fat cat come in and check out what's going on while the other cats are all away. But they're not sticking around for a long time usually. When the fat cats are away, they're just sticking their head in, maybe running an order for fun and going away. Maybe they're running a few orders, whatever. But when the markets are closed, typically, the traditional markets are closed, typically the crypto markets kind of chill out a bit. And this was not always the case, but it has become more and more the case over the last few years. And if you're wondering why, well, that's a very good question. The answer is also very simple. Okay? Who owns most of crypto now? Most of the liquid that actually matters in the market. Who owns most of Bitcoin? Who owns most of Ethereum? Big whales, right? Big banks, governments, central banks. That's who owns it. So what do you think? They're going to sit around on the weekend and play with your crypto? This isn't 2015 anymore, man. Or 2017 or 2018. Those times were long gone. These big, huge interests have taken an interest, and they've taken ownership. Some people ask, well, so what? That's not a problem. I point out that makes Bitcoin not decentralized. Yeah, and I've spoken at length about why I think it's problematic, in the sense of it has derailed Bitcoin's primary purpose, which is to be decentralized. Right? A decentralized, pseudonymous, peer-to-peer electronic cash payment system currency, and network, right? It's all those things. Well, it's not really decentralized anymore. And somebody said, what do you mean? And I pointed out, well, there's only like 13,500 people or wallets or people, organizations that actually own more than 91% of Bitcoin. So it's not decentralized. And people say, so what's the problem? Well, again, if you think it's fine, it's fine. It doesn't, it's not necessarily a problem. Personally, I think it defeats the purpose, the raison d'etre, right? The reason for being of a decentralized asset like Bitcoin. Because, right, when Satoshi made Bitcoin, the purpose of it was literally to escape the existing financial system. And by escape, I mean it was to have a new vehicle, new financial vehicle, a new financial asset class, right? A solution, a working solution that could scale, that would resolve the double spend issue for electronic cash. Because before that, there was no working double spend scalable solution for electronic cash on the internet that was native to the internet. The way, well, it's actually just native to math, but, that worked and that was built for working well on the internet as if natively, right? But again, you can use it on paper. It doesn't have to be on internet specifically, right? So when you look at that issue, hey, buddy. Hey, boy. How you doing? Luke is so good. Good boy. Good boy. Yeah. No, Lou. He's very friendly. See you, boy. Good day. Some friendly dogs. Friendly dogs. So Satoshi created Bitcoin to be a peer-to-peer electronic cash system, right? That is scalable and does solve the double spend issue. Right? If you don't know what the double spend issue is, you really should read about what cryptocurrencies are all about. Read the Bitcoin white paper, right? You can find that in a number of places. Fun fact, you can also find it if you have a Mac computer made since like 2012 or something, 2015, whatever it was. Basically, if you have a current Mac made in the last few years, for sure, you can easily find the white paper hidden on your computer, even if you never put it there, because Mac or Apple literally embedded the white paper in every Mac over the past like 4 or 5 years or more. Yes, they really did. And it is open source, so no reason why they can't do that. And yes, it's still there if you look for it, unless you've purposefully found it and deleted it. Anyway, that's kind of what I want to tell you about. So, again, what we're seeing now in the market are just really Labor Day pains, if you will, labor pains, I like to call it, for the new Bitcoin bull run that people are expecting. And I keep reminding people, no such thing as a bull run. No such thing as a bear market or bull market. It's bull pressure, it's just buy pressure and sell pressure. That's all it ever is. And if you learn how to use the VEPs, then you can trade at whatever time frame, whether there's buy pressure or sell pressure, and not be concerned about whether or not the market is mostly populated by mice, or if there's a bunch of cats around too. Now, there will always be bots, and they're doing most of the trading at any time, even right now while the markets seem to be asleep. Right? They're doing most of the trading right now, and they will be doing most of the trading even while the bots are asleep. Right? You're not gonna find a time when they're not in control. They're literally in control. So enjoy that fact and exploit that fact. And that's going to do for now. All right. Happy trading. Oh, forgot to mention. You can join the live stream in Alpha Traders Discord. We normally do them Monday through Friday at 9 a.m. Eastern Time in the U.S., excepting holidays.